Welcome to our discussion on digital wealth management and why it matters today. This presentation explores innovative financial strategies for the digital age, shown here with a mobile illustration of rising charts and a digital wallet, and will guide you through the tools, risks, and opportunities that advisors and clients face as wealth shifts onto digital platforms. This page highlights three core building blocks: robo-advisors that automate decisions, digital portfolios that enable fractional ownership, and AI-driven analytics that personalize advice. The benefits are clear: 24/7 access, lower fees, and tailored insights delivered through mobile apps, online dashboards, and secure cloud storage that make managing wealth easier and more continuous than traditional models. What we call the perfect storm combines demographic, regulatory, and technological forces that are reshaping wealth management. Mobile-first investors, post-pandemic remote advice rules, and market dynamics converge to pressure legacy models, prompting advisors to tokenize portfolios, embed crypto, and adopt API-driven platforms so they can retain assets under management rather than watching capital flee. Under the hood, automated portfolio management relies on four linked mechanisms: data-driven risk profiling to set goals, a high-speed algorithmic engine that builds and rebalances portfolios instantly, fractional share trading that removes ticket size barriers, and advanced robo-features that apply ESG filters and smart beta strategies with minimal human intervention for efficiency and scale. Distributed ledgers streamline custody by replacing centralized custodians with immutable records that enable atomic settlement and reduce reconciliation overhead. The slide also contrasts true on-chain native assets, which exist solely on a blockchain, with tokenized real-world assets that mirror off-chain claims and require legal wrappers and custody to meet fiduciary standards and regulatory compliance. Open banking APIs are the plumbing that enable wealth capabilities across digital touchpoints, from account aggregation and seamless payments to investment access. The diagram shows how APIs feed neobanks, super apps, and in-car dashboards to create embedded finance experiences, turning routine interactions into micro-wealth moments where users can save, invest, or engage financially without leaving their everyday apps. Here we compare two asset classes and their implications for diversification. Native cryptocurrencies tend to be highly volatile, globally liquid, around the clock, and often self-custodied, while tokenized assets mirror off-chain claims with market hour liquidity and institutional custodians. The key takeaway is that diversification benefits emerge only when correlation drivers and legal recourse differences are properly understood. This slide breaks down stablecoins and CBDCs and the trade-offs they introduce. Stablecoins are fiat-pegged bridges into volatile crypto markets but raise collateral, redemption, and privacy questions, whereas sovereign CBDCs promise risk-free settlement and monetary control, with a warning that yield-bearing CBDCs could displace bank deposits and alter monetary policy transmission. Traditional prudent investor criteria, diversification, liquidity, and documentation translate into digital equivalents that advisors must adopt. Effective digital custody demands rulebooks for security, multi-signature social recovery for distributed authorization, and hardware security modules for private key protection, because losing a private key is an irreversible capital loss that requires institutional controls and client-level safeguards. Regulatory frameworks are diverging globally, as illustrated by MiCA in Europe, which classifies crypto assets under a harmonized regime with clear compliance rules, versus a fragmented US. Debate over whether tokens are commodities or securities, and patchwork state licensing. For advisors, the practical challenge is cross-border clients that trigger overlapping disclosure and compliance obligations across jurisdictions. Onboarding is being compressed from days to minutes using eKYC, liveness checks, blockchain analytics, and smart contract questionnaires. The flow shortens time to service while capturing identity, biometric and financial data, layered consent, and time-stamped regulatory signatures to ensure auditability explicit opt-ins, and privacy notices are all preserved within a faster, more automated compliance framework. Behavioral science can be embedded into digital wealth interfaces to nudge better outcomes. Timely push notifications, celebrate savings, goal-based heat maps, visualize risk appetite and progress, and yield alerts flag tempting opportunities. These design patterns can boost savings, rates, and engagement, but they also require guardrails to prevent impulsive leverage or exposure to unsustainable risks in DeFi environments. Finally, emerging trends show advisors leveraging LLM copilots for cross-chain rebalancing, evaluating DeFi lending pools that offer higher yield versus traditional money market funds, and exploring metaverse land as an alternative asset class. The recommended advisor strategy is simple. Experiment in sandboxes, develop competence, and only deploy client capital once strategies and risks have been validated in controlled environments.